Well, even though we are seeing a pretty broad-based sell-off, there are some outliers out there. That comes courtesy of earnings. Goldman Sachs, M&T Bank, both reporting quarterly results that came in better than expected on a variety of metrics. This perhaps bringing comfort to investors after JP Morgan's set of results, where we saw the bank sell off by the most since 2020 on the back of their earnings on Friday. Let's bring in Ken Leon. He's Director of Research with the Financials Group, part of CFRA. Ken, thanks so much for joining me. Let's talk first about Goldman, the comfort that investors are finding, as it really looked like in all of their key divisions, they're firing on all cylinders.
And it's just starting. So we're seeing the capital markets begin to come off really the bottom last year. There still is some worries in the market, but on the results of Goldman, what did we see? We saw a strength in both equity and debt underwriting, advisory, which includes M&A, also very strong. We're talking 40, 50% year over year. And the more durable, stable businesses for Goldman did really well, and that would be the investment management. That particular area, we're seeing some very good inflows into some really high margin, high growth areas related to alternative asset management. And you know what's different this time for earnings? We had a CEO, David Solomon, who didn't have to defend a failed strategy and going into the consumer banking market as much, and just focus on what Goldman excels at, which is investment banking and institutional investing.
And do you feel like this is a vindication of Solomon as the leader of this bank? Because certainly that was thrown into question over the last year or two.
Yeah, so investors are always forward-looking, and I think for David Solomon, you know, he's got his mojo back. You know, they're focusing on the core businesses. They're moving into the most exciting part of financial services, which is private equity, private credit, either being by partners or directly investing. Likewise, as those markets grow or other areas, Goldman serves their clients well around the world. But what's most interesting for Goldman, JP Morgan, and other banks to report, the global banks, 75 to 80% of their revenue comes from North America. The other factor, as you mentioned in the intro, JP Morgan, there was lots of concerns about net interest income, you know, which is about 50% of total revenue. You know, for a Goldman Sachs or even a Morgan Stanley tomorrow, it's about 11, 13% of total revenue. So there's a little bit different focus of what moves the needle for Goldman.
And yet you seem to like, you know, these money center banks as well. You've got buys on JP Morgan, Citi, Wells Fargo. Take me into your thinking on why you're bullish or constructive there.
We love all our children, and I think Goldman and Morgan Stanley kind of fit the narrative I just described. I think with JP Morgan being the largest bank in the world, diversified, but also one that is able to still get wallet share across consumer and commercial banking. But it's a good question, and I think the answer is, as you get more into the traditional banking names such as JP Morgan or even Citi or Bank of America, the U.S. economy, and I like to say Canada too, is strong. We are not moving into recession. Whether we get one or two interest rate cuts this year, we are seeing very good demand, credit card loan activity. The volumes were very good year over year and quarter over quarter. And the concerns that any bank analyst has, is there anything risky in terms of credit loan losses? So you proportionally build loan loss reserves, but it's in the historical averages before COVID. So we got a pretty good picture. But I think when you look at who has a bigger delta for an upside opportunity, it's going to be those who are, you know, much more concentrated in the capital markets, Goldman and Morgan Stanley.
Interesting perspective. I want to ask, you know, just to your point about the risk in the credit side of things. At what point are you going to start to maybe reassess or get nervous when it comes to a sell-off in the bond market? We are looking at U.S. 10-year yield now, 4.6%. That's the highest that we've seen since November. we know what this can do, certainly in the regional sector. What's your level of concern?
Good question. And I think we look at really detailed metrics every quarter for the whole banking industry. For the 6 global U.S. banks, credit risk is manageable. Consumer, as I mentioned before, is fine. Commercial and industrial, there's no episodic event, even in energy or anywhere else, where we're going to see major write-downs or charge-offs. Of course, commercial real estate is top of mind, but it's a very small percentage of the book for the largest U.S. banks. They're much more diversified, and they're in also multifamily. To your point, getting to regional banks or the smaller banks, and even though they're not as important for equity investors, they're incredibly important for the U.S. economy. And there's risk because those are commercial real estate is a higher percentage of total loan revenue. And then the issue you have where there's either troubled office buildings or anything else in urban or suburban, what do these banks do? Do they take the write-off or do they extend the loans 1 or 2 years? I think they're going to do that because these are. I think they're going to be handled property by property. But I don't see major catastrophe here in terms of credit risk.